So we have Runts LLC was formed many years ago when Cherry, Banana, and Orange, all individuals, contributed only cash to the LLC. There's no other contributions that have been made to the LLC since formation. On January 1st this year, the partnership's balance sheet is as follows. Now, this is an extremely basic problem. This is like the most basic problem you can ever see in 751B, disproportionate distributions. So keep that in mind. This is meant to be a very, very, very low level, fundamental problem in this area. This can be very difficult in practice. It's just to show you the steps and how they work and how the pro-rata distribution rules you've learned, how that fits into disproportionate distributions. So we just have two assets. We have stock and inventory. There's no liabilities, again, keeping it simple. And then we have the capital accounts. So we have Cherry, Banana, Orange. On January 1st of this year, Runts distributes the stock, just the stock, to Cherry in complete liquidation of her interest in the LLC. What are the tax consequences to the LLC and each owner as a result of this distribution? Okay, so first thing, partnership tax problem, got an LLC, and we know that distribution's involved. Step one, when it comes to distribution problems, step one is always to determine if it's a pro rata distribution or it's going to be disproportionate, because that makes a big difference. With disproportionate, we have some special hypothetical steps we apply. So what we're asking is, we look at before versus after. We focus on the fair market value. We take the ownership percentage. That amount of hot assets needs to equal the same amount after that partner is getting. If they're exiting the partnership in a distribution, they need to receive that on liquidation of their interests. So the idea is that this rule is for anti-abuse because people are leaving, they're putting in hot assets, taking other assets, getting a basis under the rules, because as we know, it's extremely flexible, the distribution rules, but they weren't incurring any ordinary income ever. So let's look here. Cherry is leaving. We've got stock. Remember, we always assume stock is a capital asset unless we're told we're a dealer or trader in securities, which we're not. Inventory can be a hot asset. Under Section 751B, there's substantially appreciated inventory, and there's unrealized receivables, and unrealized receivables, there's lots of different types. Accounts receivable, 1245, 1250, mining issues, others. Substantially appreciated inventory. So not all inventory is 751B inventory. Substantially appreciated inventory, though, is. Substantially appreciated inventory is when you have fair market value of the inventory is greater than 120% of adjusted basis. So the fair market value here in the inventory is $6,000. Is that greater than 1.2 times the adjusted basis of 1,800? So 6,000 is indeed greater than 2160. So guess what? That inventory is considered a hot asset. Now, anything that's not hot is cold. So the stock is considered a cold asset. The inventory is considered hot. So again, this is the most basic level example you could ever see because there's only two assets. One hot, one cold. Also real simple in that there's three owners. Everyone's equal. There's no liabilities. This is so simple. It's the most simple 751B problem you can have. So we have a disproportionate distribution. Why? Because before the transaction, Cherry owns 1/3. Remember, this is the equal partnership. It was formed many years ago. They all contributed cash. If you're not told specifically in the fact pattern what the ownership percentages are, remember, if it's silent, it's equal. Plus, if you look at capital accounts, it looks equal as well. So we take the 6,000 fair market value times 1/3. We get 2,000. So that is Cherry's share of hot assets before, $2,000. After, Cherry is leaving the partnership or LLC just with the stock. Does $2,000 equal zero? No. Because after, what does Cherry have? Cherry just has stock. Cherry is no longer in the partnership, the LLC. and Cherry walks away with stock, which is a cold asset, this is not pro rata. This is disproportionate. So again, you focus on the fair market value, the ownership before and after. If it equals, you're good. But if it doesn't equal, you got disproportionate distribution. All right, so we know it's disproportionate. If it was pro rata, you just apply it like we saw in the pro rata distribution problems. When it's disproportionate, we have to do 4 steps. And these steps are very important. Now, we will be applying the rules that we've learned before when it comes to pro rata distribution. Remember, here are those rules for simple distributions, pro rata distributions, no gain or loss to partnership, gain to distributing partner only if cash distribution exceeds outside basis, loss only in certain situations, and then the important part here is going to be the tiers, tier 1, tier 2, tier 3. Now, it's possible for partnership to have gain or loss in a 751B transaction as well as other partners. So keep that in mind. But what we're saying is that part of the transaction will be treated as a pro rata distribution. You'll see what I mean when we go through the steps. So we have 4 steps that we're going to complete, which this is the analysis under 751B. The first step is we're going to construct a partnership exchange table, basically creating this hypothetical transaction. Step 2 is we have a hypothetical distribution. Step 3 is we do what's called the 751B exchange, where the partnership and the partner are going to exchange the assets in the hypothetical transactions. And then step 4, we finally have the non-751B distribution, which concludes the problem. Let me really explain what these are. So this is a 751B hypothetical analysis that's under the regs, under the rules. And really what's going on here, I know you're looking at this problem, you're saying, well, Cherry is getting the stock. Cherry's getting the stock and not getting any inventory. But the idea here is because it's a hot asset issue, a 751B issue, Cherry could technically leave this LLC without having to record any ordinary income or ordinary character loss, whatever it is. Here, ordinary income, because the inventory has built-in income, and be able to exit the LLC without having to recognize any ordinary income at any time. And this is an abuse issue. Because as we know, different tax rates, some owners will have different rates. And let's say that Cherry's in a high rate. Well, the issue is Cherry wants to avoid the ordinary income if Cherry's in a high rate. So this transaction is basically putting everyone at the same level. And again, we focus on the ownership percentage, which again is 1/3 for Cherry here when exiting. So what we're doing is, again, yes, I know that Cherry is really receiving the receiving the stock, right, which makes up 1/3 of the business. But what we're going to do is we're going to deem that Cherry receives 1/3 of all the assets and then does an exchange for the hot assets, for the cold assets. So in the end, Cherry will receive that the actual cold assets, the stock. We have to go through those steps in order because we have to do the tax consequences, and that's why using those rules for the pro rata distributions comes into play, because in some of those steps, specifically step 2 and step 4, we have to look at those rules again. All right. So the first rule is this hypothetical chart that we create, which we call the exchange table. So let's go ahead and look at that. Now, you want to create this table when you're going through a problem. And you want to create really 5 columns. The first column is where you put your hot assets and cold assets. There's also going to be, here there's 3 rows, but there's always going to be 5 columns. So the first column is just going to be where you label hot assets and cold assets. Now in this problem, we just have 2 assets, right? The hot and the cold, right? The hot asset being the inventory, the cold assets being the stock, and it's the assets of the partnership involved. The second column is going to be what we call the post-distribution interest in partnership assets. We're going to take that number, and that's the second column. We're going to add, so that's plus, and then actual distributions, including 752B for liability relief. We subtract pre-contribution interest and assets. Okay, so again, column 3 is actual distribution, including 752B liability relief. Column 4 is pre-contribution interest and assets. And then column 5, we get the change in the owner's interest. And that gives us our end result. And that actually is what we're going to use to do our hypothetical transaction for the remaining steps. So step one, getting step one right is very, very important because it affects the other steps. It's saying, okay, well, what exactly do we have to deem in the hypothetical transactions going on? So this is basically our hypothetical setup. That's what step one is. It's the exchange table. Okay, so let's talk about the hot assets, right? The hot assets here are the inventory. Again, we're focusing on what's going on in the partnership and what the partner's getting. So our hot assets for inventory, let's use red. Let's use red for hot assets. So change our font to red in the exchange table. So what is Cherry post-distribution? What does Cherry have in the partnership? Well, nothing, because Cherry does not own any partnership interest. So it's asking, hey, if the owner at issue here, Cherry has an interest after this event in the partnership, what percentage of the assets does Cherry have, or how much respective assets? Well, none. So both of the items in this column are going to be 0 because Cherry is exiting the LLC. But if Cherry was not, this would be different. Okay, so then we go to the next column, actual distribution of hot assets inventory, including 752B. Well, Cherry is only receiving cold assets, the stock, so that's also going to be 0. And then column 4 is the pre-contribution interest in assets. Well, if we look at our assets, we've got inventory and stock. We've got 3,000 stock, inventory 6,000. If we take 1/3 of each of those items, right, for the inventory, which is what we're focusing on here for the hot assets, we take 1/3, and we already did that calculation. That was the 2,000. So we put 2,000 there, positive 2,000. So now, to get column 5, which again is the change in the interest, which is our last column, our important column, because that's what's going to set up for steps 2, 3, and 4, we do the math. So we take column 2 plus column 3, which is 0, minus column 4. So far we have 0 plus 0 minus 2,000 and equals, and that's going to be a negative 2,000. Okay, so we've just completed our first row for the hot assets. Let me draw a little line there to put separation. That's our hot asset inventory line. Okay, now I'm going to change the color to blue, and now we're going to switch over to the cold assets. So the cold assets here, of course, are the stock, because it's a capital asset. It's going to be something other than 751B assets. Okay, so we go through the same analysis. So column 2, post-distribution. So Cherry's post-distribution interest in partnership assets, well, that's 0, because again, Cherry has a 0 interest afterwards in the partnership. 3, actual distribution of assets. So after distribution, what Cherry gets, including 752B, there's no liabilities, so no 752B here. Well, Cherry is getting all the stock. So all the stock is $3,000. $3,000. We use the fair market values here. So we're focusing on fair market values in this chart. So we're going to put 3,000 here. 3,000. And then 4, the pre-contribution interest in assets, and that's where we're taking the fair market values and we're multiplying them by the ownership percentage that Cherry had. So it's 3,000 in stock times 1/3, that equals 1,000. So we're going to put 1,000 there. Okay, we've got columns 2, 3, and 4. Column 5 is just the change. So let's go ahead and follow the rules. So column 2, we take 0 plus the column 3 actual distribution, which is $3,000. So far we have positive 3,000, right? 0 plus 3,000 is positive 3,000 minus the pre-contribution interest in assets, which is 1,000, and that gives us positive 2,000. All right, so we've completed our step 1 exchange table, but let me explain what this does, because you're probably looking at this and you're saying, okay, well, yeah, I can learn this table, but what exactly does it mean in terms of 751B? So this table, this step 1 exchange table, this hypothetical exchange table, what it's going to do is it's setting up step 2, 3, and 4, which we'll go through those steps in a moment. But what it's saying is, all right, we know that Cherry is getting $3,000 of cold assets, right, the stock, and no hot assets. But what we're going to do is we're going to deem that Cherry is hypothetically going to get before this actually happens. So in the end, yes, Cherry will get $3,000 of cold assets and no hot assets. That's at the end when you get to step 4. But right now, as of step 1, and determining the order of our steps, we're going to say, hey, Cherry is first going to receive $2,000 of hot assets, the inventory, so 2,000 of inventory from the partnership, and that's where step 2 comes into play. And then what Cherry's going to do is we have to go through the consequences of that as a pro rata distribution of hot assets in that distribution. So it's going to be a non-liquidating distribution in step 2, and that's how Cherry gets the $2,000 of hot assets inventory in Cherry's hands. And then eventually Cherry is going to exchange in step 3 the hot assets inventory received for $2,000 of cold assets. And then finally, Cherry in step 4 is going to get the remaining $1,000 of cold assets. So in the end, Cherry will have $3,000 of cold assets stock and no inventory. But through those steps, we track the tax consequences, and those consequences, hypothetically, in the hypothetical situations, are actually what 751B requires of Cherry in this transaction where Cherry just gets $3,000 of cold assets and no hot assets. Okay, so now we're moving on to step 2. In step 2, as I mentioned, we need to do the hypothetical distribution, and specifically, this hypothetical distribution is going to be a non-liquidating distribution, okay? A non-liquidating distribution to Cherry of $2,000 of hot assets. So this is non-liquidating, and we're applying the step 1 chart. We're applying the step 1 chart. We're saying, hey, look at the hot assets. The chart shows that Cherry receives $2,000. That's the negative $2,000 coming from the partnership. And then it's going to be exchanged for $2,000 of cold assets. And so that is where we get the $2,000 of inventory. That's right here. We need to put that in the hands of Cherry because, again, this chart is showing that Cherry eventually is going to be exchanging, hypothetically, $2,000 of hot assets for $2,000 of cold assets with the partnership. So we have to get the inventory in the hands of Cherry because, as the problem states, Cherry got nothing. So hypothetically, we have to put $2,000 of inventory in Cherry's hands. All right. So in step 2, we have a hypothetical distribution, non-liquidating distribution, $2,000 of inventory. So we go down to our rules. Now, these rules apply for pro rata distributions. Let's consider the issue of pro rata versus disproportionate in this respective distribution. Well, there's $6,000 of inventory. If Cherry is getting 1/3 of the inventory in this distribution, right, 6,000 times 1/3, Cherry should be getting $2,000 of inventory. So 2,000 of hot assets before, right, that's what Cherry's portion is, 2,000 of hot assets after. So after this distribution, so again, before versus after. So before, Cherry's share of the hot assets are 2,000. Remember, that's what we do when we compare before and after. After, is Cherry getting $2,000 of hot assets? Yes. We're hypothetically saying Cherry is getting $2,000 of inventory. Inventory in this problem is a hot asset. As we saw earlier, it's substantially appreciated inventory. It's a hot asset. Boom. This is a pro rata distribution in step 3. And it'll work out that way because that's what the chart does. It makes it a pro rata distribution on purpose that way. Okay, so because we have a pro rata distribution, we apply our rules. Remember, no gain or loss to the partnership under 731B. Gain to the distributed partner only if cash distribution exceeds outside basis. There's no cash here or liability relief, so we're good there. Loss only if it's liquidating. This is non-liquidating. So that means that Cherry and the partnership in this step 2 are going to have no gain or loss. So keep that in mind, right? No gain or loss to both partners. Both the partnership and Cherry. I should say LLC, but as you know, in partnership tax, right, if it's treated as a partner or partnership, we call everyone partners for the analysis. So no gain or loss to the LLC as well as Cherry in this step. Now in later steps, that might be different, so keep that in mind. And then we have our waterfall rules for simple distributions. Tier 1 cash, Tier 2 ordinary income assets, Tier 3. Well, there's no Tier 1 cash in this step, so we're going to bring down to Tier 2. So we have to create our little chart that we've been using that we saw in the pro rata distributions, and I'll do that again. But first, as you know, at the top of the chart, we need Cherry's basis in the ownership of the LLC. And we're given that. We're told that Cherry has a $1,000 basis using the capital accounts tax book, that number, and there's no liability, so we know that Cherry's basis in this ownership interest is $1,000, so we start with that $1,000. Okay, so we can do our little chart, right? We start with the outside adjusted basis of Cherry, which is $1,000. Again, there's no tier 1 asset, so we can go ahead and skip. We can do it. We can skip that entire tier 1 analysis. We bring down our subtotal of 1,000. Okay, so there's no tier 1. That's 0. So we bring down subtotal. So then we go tier 2. So tier 2 in this hypothetical situation, we're receiving inventory. Inventory is always a tier 2 asset. That's not even a 751B issue. Tier 2 are ordinary income assets like accounts receivable, inventory, 1245 issues like that. So the rule is we carry out inside basis limited to outside basis. So let's look at what's going on here. Cherry is receiving 1/3 of the inventory, right? There's $6,000 of inventory, $2,000. Let's do this calculation over here to give us some room because we're going to have some crazy calculations later on. So in step 2, Cherry receives $2,000 of inventory. There's $6,000 of inventory total, right? This is Cherry's, I'll say call it C's portion of inventory. And this is the LLC amount. So that equals 1/3. We focus on the fair market values. So since 1/3 is what Cherry's getting, we're going to take the adjusted basis, that inside basis rule, we're going to take the 1,800 times 1/3 to get our basis rule, and that equals 600. So Cherry, using the rule, Cherry is limited, right, to the inside basis. So carry out inside basis. Cherry is limited to $600 or whatever Cherry's basis is after tier 1, which is 1,000. So the lesser of 1,000 or 600 is 600. So Cherry takes a 732 adjusted basis in the inventory, right, in the inventory of 600. And then we're going to reduce the basis down to 400. So there's 400 left after that. There's no tier 3 assets because remember, Cherry is only getting in this transaction just 2,000 inventory. So tier 3 is 0. And finally, is this liquidating or non-liquidating? Because if it's a non-liquidating versus liquidating, it makes a big difference. If it's non-liquidating, then we apply the same rule as tier 2, which we have nothing, and then the remaining the basis of the partnership goes to whatever is left over. But this is non-liquidating, right? It's not liquidating, it's non-liquidating distribution. We said that earlier. That's very important to understand. This step is non-liquidating. We don't get to the liquidating portion until step 4, until the end of the day when all the dust settles. So that 400, that is the adjusted basis that Cherry has in the partnership interest or LLC interest after step 2. After step 2. So we've just determined the consequences of step 2, right? No gain or loss LLC or Cherry. And the basis that Cherry takes, the inventory, is 600. And then the basis that Cherry has left in Cherry's interest is 400. Now, in addition, we need to look at the partnership balance sheet. So let's go ahead and do that as well because some stuff has changed on that respect. So the partnership still has both inventory and capital asset, right? The stock and the stock. So we need our columns, right? The adjusted basis and the book amount. Of course, there's no liabilities, as we saw earlier, so that's going to be 0. And then the capital accounts, those are going to change as well for Cherry, banana, and orange, right? Cherry is C, banana, orange, right? And we have our tax, capital accounts, and we have our book numbers. Now the inventory has been reduced from 6,000 to 4,000 because 2,000 has just been distributed and the basis has gone down by 600. So we take the 6,000 fair market value inventory minus the 2,000 that just was distributed to Cherry after as a result of step 2, and also the basis of 1,800 is reduced by 600 because we had to allocate that basis. So the inventory, the book amount goes down to 4,000, and just the basis goes down to 1,200, right? 1,800 minus 600 is 1,200. The stock stays the same. That has not yet been affected, right? So far, we have not gotten to the stock in our hypothetical transactions. So 3,000 fair market value, or the book, and the basis is 1,200. That's given to us. So if you go back to that, you'll see that. Again, no liabilities, right? B and O, banana and orange, theirs have not changed. So if you look back at the respective capital accounts, right, banana and orange haven't been touched. 1,000, 3,000 is still the same. So we can go ahead and put those as well, 1,000, 3,000. Now with respect to Cherry, Cherry is going to have a difference because Cherry just got a withdrawal from the LLC of $2,000 of inventory. So that means Cherry's, yes, Cherry owns 1/3, but that withdrawal comes out of Cherry's capital accounts. So Cherry goes down from 3,000 minus 2,000 is 1,000. And then the tax capital account, right, the basis, we just determined, hey, Cherry has a $400 amount left. So that is 400. All right, that's 400. Okay, so we are done with step 2. We've just gone through the consequences. Again, no gain or loss to LLC or Cherry. We looked at the basis that Cherry takes in the inventory. We saw that Cherry now has an LLC interest of 400, and we just did the balance sheet for the actual LLC, the partnership. Okay, so now we're going to go down to step 3. I'm going to change a color. Let's do a green. We're going to do green for step 3, just to change it up so you can see some delineation with respect to the steps. So step 3, now what's going to happen is we're going to have what's called the 751B exchange. And what's going to happen here is, all right, we did step 1. We did our hypothetical table to see what's going to go on in steps 2, steps 3, and step 4. And as I explained earlier, in step 2, using that table, Cherry is going to get in Cherry's hands $2,000, a distribution from the partnership, as we saw as pro rata, distribution non-liquidating, $2,000 of the hot asset in respect to that transaction. So now after step 2, Cherry has $2,000 of inventory, but remember, ultimately at the end of the day, Cherry needs $3,000 of the cold asset stock. So how is Cherry going to get that? So in step 3, what's going to happen is that $2,000 of inventory that Cherry receives, Cherry is then going to trade it, right? This is Cherry. Cherry now has this. Cherry's going to trade it with the partnership for $2,000 of stock or cold assets. And again, that is exactly what that table is showing, right? We got the $2,000 exchange of hot for cold, so there's going to be this switch, and that is why we have the negative 2,000 hot and the positive 2,000 for the cold, because this is actually showing that flip. So technically, this table really isolates step 3 of the exchange, the 751B exchange. So this exchange table is really referring to this step 3 exchange table. Step 2 is, hey, well, if there's going to be a $2,000 flip, well, Cherry needs to get $2,000 of hot asset in Cherry's hands, and then we can do the flip in step 3. Step 4 is just to finally clear all, make sure that everything is the way it actually is at the end, which remember, Cherry gets $3,000 of the stock in the end. Okay, so we have this transaction, $2,000 exchange. This is an exchange of the inventory Cherry just got from the partnership for $2,000 of stock from the partnership. Okay, we have to look at the consequences to both sides. Let's first start with Cherry. Well, as we know, in property transactions, right, inventory and stock are both considered property. Section 1001 requires that any sale or other disposition, which includes exchanges, you have to do the amount realized minus the adjusted basis. Minus the adjusted basis. And we calculate that. So amount realized is what Cherry's getting. The actual formula is actual cash received plus constructive cash, which is liability relief, plus the fair market value of non-cash property minus selling expenses. So Cherry here is getting $2,000 of stock, fair market value $2,000 of stock. So Cherry is getting $2,000 of stock minus what is Cherry giving up? Cherry is giving up inventory. You look at the basis of that inventory. We just determined that basis. It's $600. The basis of the inventory is $600. So Cherry is going to subtract away $600. Cherry has a $1,400 gain. Now, what is this $1,400 gain? What's the character? The $1,400 gain, which is going to be realized and recognized. By the way, it's going to be recognized because it's an exchange. There's not going to be any non-recognition rule that's going to apply here, right? There's no like-kind exchange or involuntary conversion or some other rule. So it's going to be recognized by Cherry. So $1,400 gain recognized by Cherry. The next step is determining the characterization, right? Remember, the 3 steps of property transactions are 1, calculate the realized gain or loss. That's what we just did. Step 2 is determine if it's recognized. It is, right? No non-recognition rules apply. Step 3 is determine the character. Well, what is Cherry giving up? Cherry's giving up inventory. Inventory is always going to be an ordinary asset in the hands of the owner that has inventory. So it's going to be an ordinary gain. So this $1,400 that Cherry recognizes is going to be a $1,400 gain, specifically a $1,400 ordinary gain. Okay, so we have the consequences of step 3 to Cherry. $1,400 ordinary gain. We're not done yet. You might have jumped the gun and said, okay, well now we got to move over to the partnership. There's one other issue we need to consider, right? Don't move on too fast. I'm trying to help you here. My job is to help you. So we also have to determine, hey, what's the adjusted basis that Cherry takes in the stock? So the adjusted basis in the stock that Cherry receives in this transaction, specifically the $2,000 of stock, right? Cherry is receiving $2,000 of stock from the partnership. What basis does Cherry take? Well, under section 1012, this is going to be $2,000. It's the amount that Cherry is either paying or giving up, right? Cherry's giving up $2,000 of inventory in exchange for $2,000 of stock. So Cherry takes a $2,000 adjusted basis in the stock for this portion of the stock. Now, the portion issue is going to be important later on because in the end of the day, we're going to have to look at the ultimate tax consequences to both sides, so keep that in mind. All right, now we can move on to the partnership, the consequences to the partnership. So same thing, partnership as an exchange, it's the other side of the exchange. We have to look at the consequences there. Again, section 1001, amount realized minus adjusted basis. Remember the steps for property transactions. Step 1, calculate the realized gain or loss. Step 2, determine if it's recognized. And step 3, determine the character. Got to do the same thing for the partnership. So what is the partnership receiving here? It's receiving $2,000 of inventory from Cherry. So that is going to be the amount realized, right? Because the fair market value of non-cash property is $2,000 minus the adjusted basis of property it's giving up. Well, it's giving up $2,000 of stock. What's the adjusted basis of the stock? Well, there's $3,000 of stock, which is a basis of $1,200. So again, we're going to do a similar type of formula like we did earlier, right? There's $2,000 of stock being given up, but there's $3,000 total. That equals 2/3 under the regs in section 1012 and with respect to basis. The $1,200 basis in the stock, since only a portion is being sold, we're going to take 2/3 times 1,200, and that equals 800. So 800 allocates that basis. The idea here is, let's say you were selling, you have 10 shares of stock in a corporation, and you sell 6, and you have the same basis in each share of stock as you bought it all in one transaction. If you sold those 6 shares of stock and you kept 4, you're not going to give the entire basis in all shares to those 6 shares. You're going to give 60% of that amount to those 6 shares. Same idea here, right? We're giving 2/3 to this portion because we're only getting rid of 2/3 of the stock in this transaction, in this exchange. Okay, so we subtract away $800 basis in the $2,000 of stock we're giving up. So there's a $1,200 realized gain under section 1001. Is that recognized? Yes. This is an exchange. There's no non-recognition rule that applies like-kind exchange or involuntary conversion. So the LLC must recognize this amount. Now the last step, step 3, is to determine the character. Partnership is giving up stock. Stock is a capital asset. Okay? So this is going to be a capital gain. And you'd have to be told if the stock was held for more than a year or less than a year, all that stuff. Let's just assume for this problem, just to make it simple, because let's assume this partnership has been around for several years. They bought this stock at the beginning. So let's just say that it's a long-term capital gain. I'm going to tell you with respect to this fact, okay, we're going to assume the stock has been held for more than a year. Okay, assume stock has been held by the partnership for more than 1 year. So then that would be a long-term capital gain. Of course, if I gave you a problem or your teacher or professor gave you a problem, they'd have to actually tell you how long the stock has been held by the partnership. Of course, if they don't, you could always you could just say capital gain. Oh, it would be long-term capital gain if the stock's held for more than a year, short-term capital gain for a year or less. So the partnership has $1,200 of long-term capital gain. Now, here's something really important. As we know, partnerships are flow-through entities. So you might be wondering, okay, if the partnership reports $1,200 of gain, how does that get reflected? Well, yes, we have yet to get to the point that Cherry is going to leave the actual LLC. That happens in step 4, a liquidating distribution, right? We're only in step 3. But under Reg 1.751-1H2, this $1,200 gain is going to be split between Banana and Orange based on their ownership percentages after Cherry leaves, which because they both own, or all 3 owners own 1/3, 1/3, 1/3, and when Cherry leaves, it's just going to be Banana and Orange equally. It's going to be 1/2, 1/2. So Banana gets 1/2, Orange gets 1/2. So that's going to be 600 of that gain that gets allocated to Banana on Banana's K1, and 600 gets allocated to Orange on Orange's K1. All right? On Orange's K1. So keep that in mind, again, because their ownership, their equal ownership before, but when Cherry leaves, it's going to be Banana and Orange equally, so 600 gets allocated. We're not done. We're not done with the consequences to the partnership. We have one last thing, right? What is the adjusted basis the partnership takes in the inventory? Well, again, similar to what we just saw with Cherry, right, under Section 1012, we have an exchange, and you're giving up this capital asset, this stock, for this portion of inventory. So it's going to be the fair market value of the stock given up, which is $2,000. So the inventory, this portion of inventory received, takes a basis of $2,000. Now, again, this is a portion of the inventory, so keep that in mind. That's what students get confused. So note that I said that this is a portion here, right, because again, at the end of the day, after step 4, so we're going to do step 4 in a moment, but you're going to see that at the end of the day, Cherry's receiving $3,000 of stock. Well, as of step 3, Cherry only has $2,000 of stock. So we're looking at this portion of the basis. We're going to have to add those together in the end. We're going to do all 4 steps, and then in the end, we're going to determine the consequences in the end, looking at all 4 steps. Same thing with the inventory. The partnership has inventory only a portion because in the end, things are going to be a certain way. And with that, the last thing we're going to do in step 3, before we move to step 4 and finish off this problem and look at the ultimate tax consequences, is again, we're going to do another balance sheet, a balance sheet after step 3. So we've got our assets over here, right? We still have, the partnership now has received inventory, and it still has some of the stock. It still has some stock. So we have to keep that in mind, right? The adjusted basis, and we have the book amount. So think about what's gone on so far after step 1, step 2, step 3. And we're not yet to the point that the partnership has given up $3,000 of stock, all the stock, and that's it to Cherry. We have yet to get to that point. We're tracing step 1, step 2, step 3. So remember, step 1 was just create that chart. Step 2, Cherry got $2,000 of hot assets. Step 3, the partnership exchanges, gives up $2,000 of stock for $2,000 of that inventory, that hot asset. So after this step, the partnership now has all the inventory back, all $6,000 of inventory, right? All $6,000 of inventory. But now for the stock, it only has $1,000 because it's given up $2,000 of stock. Okay, the adjusted basis. The adjusted basis of this item. Let's start with the stock first. So we did that calculation earlier. Where we took the 1,200 basis, right? This green number here, 1,200. And remember, we gave up 2/3 of it, right? $2,000 was given up. There's $3,000 total. 2/3 of the 12, we multiply by 1,200. 800 basis is gone. So if we take 1,200 minus 800, we only have a $400 basis left in that amount. Okay? So the adjusted basis and the $1,000 of stock left is going to be 400. That's the 1/3 of the 1,200, right? That portion left over. For inventory, okay, so now what we're going to do is we're going to look back at our balance sheet. This is why using the balance sheet is so important. We had $1,200 here after step 2. So that $1,200 still is on the books. And then after step 3, the partnership now has acquired $2,000, this portion. So now the basis in inventory is the $1,200 portion from step 2 and the $2,000 portion from step 3. So this problem is, again, a very, very basic level 751B problem. But as you can see, this gets really, really, really crazy because you got all these hypothetical portions going all over the place. So that's what my job is to show you these calculations slowly as possible. Make sure you go back over this video. We're not done yet, but I'm just telling you, I'm showing you why it's so important to practice this problem over and over. So we add those two portions together. That gives us the total adjusted basis in the entire $6,000 of inventory. So the basis in the inventory is $3,200 in the partnership. That's going to be very important because as the partnership goes on, it has to keep track of that. There's no liabilities. So liabilities are 0. There's no liabilities in the entire problem. And then we have our capital accounts. So the capital accounts are actually going to be identical to what we had in step 2 for cherry. However, for banana and orange, they just recorded a $600 gain each. So that is going to go into, again, this one on the K1, right? The partnership recorded that goes on their K1s, so we have to adjust for that. So again, we have our tax capital account, and then we have our book. So for cherry, it's identical to step 2. We have 400 and 1,000. That's identical. Okay? 400 and 1,000. And then for banana and orange, it's the same as step 2. It's the 1,000 here, but we have to add on the 600 here. So the basis is now 1,600. Why are we doing this? Because under section 705, as we've seen in previous videos, we have to adjust our basis up for gains, income, tax-exempt interest income, things like that. And that's what we have here. Under K1, they're allocated $600 of gain each. Now, there hasn't been any withdrawals by banana and orange, so we're still at $3,000 book capital account. And if we add those all up, we're going to get these amounts. We're going to get 7,000, and this is going to equal 3,600. And then here it also equals 3,600 and 7,000. I didn't add them up earlier in this problem, but they also equal as well. I forgot to do that as well. So you can go back and do that in your notes because I know you're following along, or if you're not, you should, right? This is 2,400. This is 7,000. This is 2,400. And this is 7,000. So I apologize for not calculating those earlier, but as you can see, they do balance. And I wanted to at least show you that because now we're looking at 2 balance sheets. All right, so we've now finished step 2 and step 3. Again, in the end, we're going to come back and look at all the consequences. Now what we're going to do is we're going to do step 4. Step 4, I'm going to switch back to a different color font. So we have step 4. So we're basically going around the world here, around our chart. So step 4 is all about the non-751B distribution. So what I mean is, step 4 is all about getting to the end result. So again, think about what's going on. We did our step 1 hypothetical chart. That sets up for step 2 and step 3, specifically step 3. Step 3 is the focus, but step 2 is to get in our hands, or Cherry's hands, the hot assets, the inventory, because that doesn't really happen in this problem. That's not what we're told. So step 4 is basically we have to make sure that what actually happens. So after step 3, what does Cherry have? Cherry has $2,000 of stock. But we're told in the problem that Cherry is supposed to receive $3,000 of stock. So what are we going to do? We're going to make a $1,000 distribution of stock by the partnership to Cherry. And after this transaction, what's going to happen is Cherry will have $3,000 of stock, no partnership interest, and no hot assets. And that's exactly what happened. And then what we do, and that's what we want to make sure that it works out that way. And what we do is we then go through all the steps and look at all the consequences that happened, and that is how we analyze the consequences to the partnership, the partners, including cherry, banana, and orange. We look through all those and we summarize those, and we also create the balance sheet afterwards. So this is a liquidating distribution. The reason why is because, as we're told in the problem, cherry is going to liquidate. If this was non-liquidating, it would not be a liquidating distribution. So this is a $1,000 distribution of stock. All right. So if we look at our problem, now in step 2, cherry got cherry's share of hot assets. So when we get to step 4, the $2,000, well, let's look at our new balance sheet. Okay. Inventory is $6,000. Well, cherry got cherry's share of inventory back in step 2. So for purposes of step 4, it's considered pro rata. It's a little confusing. You're like, well, I thought you look at the inventory, you take the portion. Well, cherry did get cherry's portion back in step 2, so we have to keep track of that. We have to keep track of the fact that, hey, cherry got cherry's share of inventory, so cherry's good. So now the remaining inventory is allocable to banana and orange solely. Cherry is out of the picture when it comes to the hot asset. Well, there's no other hot assets in the problem, so this is going to be a pro rata distribution. A pro rata distribution with respect to the $1,000 distribution of stock. It's a liquidating distribution. All right. So as we know, where do we start? We start with cherry's basis and the partnership interest. Well, we determined that at the end of step 2, which was 400. We can also see that here, if we go to step 3, the balance sheet, that's the same 400. So that is our starting point. We're going to use our table, right? Cherry's outside adjusted basis, it starts at 400 minus tier 1. There's no liabilities, no cash being received. So we bring down that number, that 400. Okay. So then we go to tier 2. Is cherry receiving any tier 2 assets in this problem? No. Cherry's just getting $1,000 of stock. The stock is a tier 3 asset. So again, we bring down 400. So then we go down to tier 3. Remember our rules? No gain or loss to the partnership. So no gain or loss to the partnership. It's pro rata. It's pro rata. There's no cash. And then loss if it's liquidating, but there's no tier 3. Well, we do have tier 3. There's no tier 1, no tier 2 in this distribution. Tier 3, if it's liquidating, the distributed asset takes the remaining outside basis. So that means that the tier 3, which is the $1,000 portion of stock, takes a $400 basis, and we're done with the analysis with respect to cherry C. Okay? And there's no consequences here with respect to the partnership or the other partners, banana or orange. The last thing we have left to do is to show the final balance sheet. So this will be the final balance sheet of the problem because this is the end of step 4, which is our last step. Okay, well, the partnership LLC only has one asset now. It has inventory. The inventory amount has not changed from step 3. It's still adjusted basis 3,200. Book amount 6,000. That has not changed. Okay. So we have inventory. Adjusted basis again 3,200. Book amount 6,000. That has not changed. There's no liabilities. That has not changed at all. And then for capital accounts, this was liquidating. So because it was liquidating distribution, cherry is no longer an owner. We just have banana and orange. We've got our tax and book accounts for capital. And those are going to be the same for banana and orange because nothing has changed. We got 1,600, 1,600, 3,000, 3,000. So we're going to put those numbers there. So 1,600, 1,600, 3,000, 3,000. We add them together. We get 3,200 and 6,000. That's how you know it's worked out, right? The balance sheet is assets equal liabilities plus owner's equity. They need a balance. They do balance indeed. And look at that. It works. We are done with all 4 steps. But we're not done with the problem. Because to conclude the problem, we need to do a summary. A summary of the tax consequences. Summary of the tax consequences. So first, I always start with the partner receiving the distribution. So here that's cherry. So cherry's consequences, we go through the steps. Go in order, step 1, 2, 3, 4 in order. Okay, So in step 1, that's the hypothetical exchange table, which is used for step 2 and step 3. And again, step 4 is just the cleanup, right? You're cleaning up. Cleaning house, cleaning up. Step 2, what happened? What happened to Cherry and what happened to the partnership? Well, Cherry received $2,000 of inventory, which Cherry took a $600 basis, and there was no gain that Cherry recorded because it was pro rata. There was no consequences to the partnership other than the balance sheet being adjusted, but we have our final balance sheet, so that's fine. Now, because Cherry ultimately does not end up with inventory, the basis of the inventory does not affect our ultimate consequences because Cherry doesn't receive inventory. We're focusing on the fact that Cherry receives $3,000 of stock in this problem, all the stock. Okay, so now we go down to step 3. So step 3 is where you find almost all the consequences to the parties. So Cherry has a $1,400 ordinary gain. So let's go ahead and write that. So Cherry has $1,400 of ordinary gain. So we put that down. All right. What else? Cherry received in this transaction $2,000 of stock from the partnership. And that basis equals $2,000 as we calculated there. All right. Now, there's no other consequences to Cherry. We'll come back to this step for the partnership and banana and orange, but for Cherry, there's no other consequences. Yes, we drew our balance sheet. No other consequences to Cherry. So now we go to step 4. Step 4, it was a pro rata liquidating distribution of $1,000. No consequences to Cherry in terms of gain or loss, right? There was no gain or loss on the transaction to Cherry because, again, we have no cash distribution or liability relief distribution, no tier 1, and then there was tier 3, so there couldn't be a loss. But we do have a $400 basis in the $1,000 portion of stock. So to get the ending basis in the stock, so remember, Cherry receives $3,000 of stock. This is our adjusted basis calculation. So we have to add together the portions. So in step 3, we determine that the $2,000 portion, this portion here, we have an adjusted basis of $2,000. So let's go ahead and put that in there. We have $2,000 portion has a basis of $2,000. And the $1,000 portion in step 4, we determined the basis here had a $400 basis because we applied the rules of our chart and that gave us a $400 basis. So that means that the adjusted basis of the stock in Cherry's hands is $2,400. So the ultimate consequences to Cherry is that Cherry's going to have a $1,400 ordinary gain. That's the first item. So Cherry's going to report $1,400 of ordinary income. And then the basis, the adjusted basis in the stock that Cherry takes, the $3,000 of stock, you're going to have a $2,400 basis there. So those are the consequences to Cherry. All right. So now we have to do the consequences to the LLC, the partnership. So we go through our steps. Well, step 1, again, is the exchange table. Step 2, we don't have any consequences to the partnership, no gain or loss recognized. And then we drew our balance sheet, but again, that changes. Step 3, yes, the partnership does have a $1,200 capital gain. And that was allocated $600, okay, under Reg 1.751-1H2. So we have to go ahead and record that. So $1,200, so this is actually the consequences of the LLC and banana and orange. So really, it's all 3 of these parties, I should say, because as we know on the 1065, the LLC is going to have to report this on the 1065, and then it's going to flow through to LLC. It's going to flow through from the LLC to banana and orange. So the LLC has to report a $1,200 capital gain, right? And we assume in the problem that the stock was held for more than a year, so it's actually a long-term capital gain, and that's going to be broken $600 of long-term capital gain to banana and $600 of long-term capital gain to orange. So we saw that, okay? And then that was the consequences of the transaction, the exchange in step 3. Then we drew out a balance sheet, but we have a new balance sheet that's going to give us more information in a second that's better from step 4. So we're just going to focus on that. And then step 4, we saw no gain or loss to the parties, right? The partnership, LLC, or Cherry. So the LLC doesn't have gain or loss. And then our final balance sheet, which is right here, this is going to be the same balance sheet for the partnership at the end, right? We have only inventory left. The adjusted basis of the inventory is now $3,200. The book amount is $6,000, right? Because that's all that's left. Again, all that Cherry's gotten is the stock. So adjusted basis is now $3,200. The book amount is $6,000, which is correct because we started with $6,000, right? It's gone up and gone down and gone back to $6,000, right? Well, it doesn't gone up. It went down and then went back to $6,000. So we got back to $6,000. The stock is now gone, which is what ultimately happens, right? Cherry takes that $3,000 of stock. Inventory, the base has gone up to $3,200. Fair market value is $6,000. Liabilities are still zero. Cherry's capital account is now removed because Cherry has left the partnership. And then Banana and Orange, their tax capital account has gone up because of $600 of gain they recognized each. That flows through on their K1. And then their book capital account stays the same because they economically haven't had any change. And it all balances. So this is the balance sheet and all the items. That is still the case. All right. So that really concludes this problem. I hope you've enjoyed this. This one, again, is the most fundamental level. You can see how this can get more involved. We have liabilities. We have different types of hot assets. We have different types of cold assets involved. This is the baseline example. And as you saw, it's very, very, very involved. However, the fundamentals, whether it's more complex or not, are still the same. You go through these hypothetical transactions, you go through the hypothetical steps in this order, and ultimately you put the pieces together in the end, and you get the consequences. Now, again, think about it, right? The last thing I want to do is I want to just remind you what actually happened here. Cherry received $3,000 of stock. If we applied the normal pro rata distribution rules, Cherry could technically leave this transaction without any gain or loss, right? Because if it's liquidating, and we saw from our chart, hey, liquidating distribution, if you have tier 3 assets, which the stock would be no gain or loss, and you take a basis in the stock equal to the lower of the basis that you have in your partnership interest, which is 1,000 or what the partnership has, and there'd be no gain or loss. But ultimately what you saw is, hey, Cherry has $1,400 of ordinary gain. The stock is going to take a $2,400 basis, not a $1,000 basis, and the partnership and the partners other than Cherry actually have consequences as well. So it affects things differently than it would under the normal distribution rules, which are more flexible. This is all about anti-abuse. This is a way for Congress to stop what a partner or owner or member of LLC would do if they were allowed to use those flexible rules to basically structure a partnership and get out of a partnership with no gain or loss and avoid ordinary income potential. So that's really what we're doing here. And again, go back over this video. Go through as many times as you want until you understand. Eventually, at some point, it clicks. But the idea is the steps. We do those 4 steps, and we put the pieces together to get the ultimate consequences. All right, I hope you've enjoyed this partnership tax video. Please watch more videos on various topics.